Hi everyone, we'll be just starting in 1 or 2 minutes. Welcome everyone. Thank you for joining the Office Leadership Series. In today's session, we'll be discussing the outlook for CRE market in medium to long term and the innovative strategies being adopted by leading developers to navigate the second wave of the pandemic. The pandemic has brought about major shifts in the way people work and live. And now with the second wave, it has become important for CRE developers to realign their strategies to thrive in the ever-changing industry. The experiences of 2020 are now reshaping the relationships between the occupiers and developers in 2021 with far-reaching implications for the future of commercial real estate. Today's webinar will be moderated by Amit Ramani, founder and CEO of Awfis. Now, it is my pleasure to introduce our esteemed panelists for this session. I first welcome Sanjay Dutt, MD and CEO, Tata Realty and Tata Housing. Sanjay has over 26 years of experience in the real estate sector, having worked previously with esteemed organizations such as Cushman & Wakefield, JLL, and Ascendas. Expert in strategic planning and real estate management, Sanjay is also the founder member of RICS, India, and joint chairman of FICCI. Welcome, Sanjay. We are excited to hear your valuable thoughts on the topic.
Thank you.
Now I welcome the next speaker for our session, Arpito Mukherjee, who is currently serving as the managing director at Apollo Global Management. He's a senior professional with years of international experience in executive roles in banking, corporate finance, and operations. Arpito also had an entrepreneurial career path with a track record of delivering results in diverse businesses, roles, and geographies. Prior to Apollo, he has been associated with firms like Merrill Lynch, UBS in UK, Dell in US, and GE Capital India. A warm welcome to you, Arpito. We're delighted to have you today with us.
Thank you for inviting me.
Up next, we have with us Vinamra Srivastav, who is currently the CEO of Business Park Capital Land India, responsible for overseeing investments, operations, asset management, and strategic planning for Capital Land Group's business parks in India. Vinamra also has vast experience in areas like strategies and operations, having worked with global firms like Ascendas Singbridge, Roland Berger, Arthur D. Little, Cisco Systems, and BCG prior to Capital Land India. Welcome. We're thrilled to have you on board, Vinamra.
Thank you for inviting me.
Moving on to the next panelist, we have with us Amit Devan, MD and Country Head, Heinz India. Currently, he is responsible for all activities of Heinz in India, including fundraising and deployment, joint ventures, project deployment, project development, asset management, partner relations, and exits. Prior to joining Heinz, Amit has worked for a variety of real estate firms, including Piramal Group, GE Real Estate, and JLL across India and Southeast Asia. Welcome, Amit. Looking forward to hearing your insights on the topic.
Thank you, Sumit.
And last but not the least, we have Vinod Rohira, currently serving as the MD and CEO of CRE and Reits Cre Corp, where he has been in leading the across India. A veteran in the realty industry, Vinod is one of the FICCI real estate on the FICCI real estate committee to drive policy changes in India. Additionally, he's also part of the South Asia Leadership Forum for CRE and Facility Management of RICS. Welcome, Vinod. It is wonderful to have you on the panel today.
Thank you very much.
Over to you, Amit.
Thank you, Sumit, for the introductions. Good afternoon, ladies and gentlemen. It's extremely rare occasion that you get an opportunity to moderate all your personal rock stars on a single platform. I'm extremely delighted to be moderating a panel of stars from top developers in India to discuss how CRE can effectively navigate the way forward. One of the few resilient segments that weathered the storm fairly well was commercial real estate. While the last few months have been a bit tough, with uncertainties coming as part of the second wave, brighter prospects are on the horizon for the second half of 2021. With vaccinations across India, medicines around the corner, and hopefully no third wave, there is extreme optimism. As a result, there has been a paradigm shift across the CRE industry, and developers need to take the lead in re-strategizing their portfolios with agility to meet the ever-changing demands of our occupiers. In today's session, we discuss what this year will hold for the CRE industry in India, where it's headed, and how it can gain momentum in the coming months. I believe these panelists have the pulse of the entire CRE industry and can provide extremely valuable insights. Starting with the first section on developer-occupier dynamics, while the CRE industry is likely to recover in the coming months, the 2021 foresees a strong partnership between the occupiers and the developers. As many corporates are reanalyzing their workplace strategies for 21 and beyond, it seems certain that there will be stronger demand for distributed workspace. Occupiers will continue to demand smarter, safer, and flexible options, while developers will have to be nimble when dealing with occupiers to continue to thrive in this coming years. Sanjay, starting with you, you have been there, you've seen it all. You've been part of the IPC world, investment focused fund, and now you lead the real estate portfolio for one of the largest conglomerates in India. Most occupiers today are considering adopting a work model that combines remote work and office time. Can you tell us the changes you have observed in the occupier behavior from the last year to now, and where is this developer-occupier dynamic heading?
Thank you very much. I will take a minute only to go back in history. It was in 1995, 96, and I remember IBM had set up a dedicated specialized unit in the organization called Environment, Health and Safety vertical. And I think it was during those days when we saw the commitment to occupiers commitment to the industry go up. And a lot of emphasis at that point of time was around the safety and security. It was to do more with asset than the employees. And over the years, of course, things have dramatically improved and got scaled. The difference between last year and this year almost all of them have communicated. Thankfully, the sector has been these assets, but ever since the institutional capital that has come into the country, we've seen the bar being raised and investment in building the right environment from the occupier's point of view has gained a lot of significance and momentum. I saw a very healthy dialogue between the developers and the occupiers and investors. I would say even the government actually participated in making sure that how we elevate. Clearly, most of us know that with less than 2% to 4% of working population that came to our parks during the pandemic, the emphasis was on the life and safety of the employees. And we could also do that because the infrastructure was robust and you could work from homes. And I think the results and performance of these companies is visible with the results that you saw in the stock market, because a significant part of this is the BPO. That we have seen is that they want to make sure that the assets are relevant in today's context. We've seen a significant change from occupiers' point of view that if they actually feel that the new benchmarks of safety, environment, health and safety, and the wellness of the developments is not in line with what the standards today demand, they would exit the leases. And I've seen a pattern in some of the lease renewals and terminations where occupiers have let go of the assets. At the same time, the occupiers have given higher weightage and renewed their leases and even gone ahead and committed to escalations in rent. And got occupied during the entire year on an average, barring few. So I see a very clear focus and trend on assets which actually live up to the safety and wellness of the employees. One clear trend we've seen is uh, repurposing the office. I think majority of the occupiers have deliberated last year on work from home versus work from office. I think they have broken the myth that working from office is far more productive than working from home. Not that they will not allow employees to work from home, they would allow, and flexibility is the new norm. But working from office is far more productive. It's clearly demonstrated. How will they repurpose the office while balancing between work from home and work from office has been extensively discussed, and therefore a lot of learning and development, a lot of emphasis on collaboration in the office and building the right infrastructure to ensure that you inculcate the culture of the organization into people when they come into the office has been played out. I think a lot of necessary infrastructure from the developer side has also gone in. We didn't want to, we did invest in some short-term measures to make our assets touchless or reduce whatever concerns or deterrents were there, even in terms of perception in the minds of occupiers or indeed the employees coming to office. We were able to overcome by taking those measures. But right now, as we speak, all of us are working with the vendors and various technology initiatives that various vendors have taken, whether it is to do with indoor quality of air or it indeed the safety and security of the employees, even managing the peak traffic hours to ensure social distancing, et cetera, et cetera. So I think it's a evolving process. And I believe over the next 12 to 24 months, we would have evolved even more and embraced a lot more newer technology to make our parks more relevant and repurpose our park. And I think a lot of investment, and thanks to the fact that out of nearly 600 million square feet, nearly 400 is nearly institutional ownership. So you will see a lot of investment going into this space. Thank you.
Great. Thank you, Sanjay. Amit, starting with you now, you have obviously a great experience from leading a large real estate portfolio for a large conglomerate to now leading the largest real estate and asset manager in the world. According to you, how have developers restructured their portfolios to meet the current expectations and to stay current in the current times, relevant in the current times? And what are the future plans considering the muted demand in short term for real estate commercial assets?
Thanks, Amit. There's really, three different reactions on the restructuring and future plans. So the first category is balance sheet restructuring. Every time there is an external shock, and COVID was no different, developers and owners of assets kind of look at their balance sheet and take a call on what exactly is their primary business. So are they really in the business of making development profits or holding an asset for long term? And what you've seen in this post-COVID era, and you'll see that after every crisis, is that there will be several new opportunities for investors where the existing owners say, you know what, I don't want to be in this business anymore. Let me lighten my balance sheet and plow back that profits into my core business. So that's kind of one. The second is those who continue to own the asset, Sanjay mentioned about the dynamics between the owners and the tenants during this period. This had to be a lot of asset upgrades. Those who own the assets are seeing pressure because of the dip in the leasing market. It's a short-term dip, but there's definitely a dip. We know the statistics. 2020 and 21 will not have the same leasing velocity as 2019. It's a given. So there are corrective actions to be taken. Thankfully, the corrective actions have been limited on the rent concessions or free parking and freebies like that. The bigger change, which is very positive, is asset upgrades. So you have several instances of improvement in technology, thinking about how to improve the circulation in common areas, better health and safety standards, and all of this is rapidly improving. So you see that massive change in the portfolios that we see around us. And the third is, if somebody has a portfolio really of land bank, or the asset development is really at an early stage, it's given people time to rethink and even adjust to their strategy. So there are many, developers who are contemplating whether it's a wise idea to start a new office development today or not. Suddenly, land parcels which have the possibility to change use, some of those land parcels may get redirected to the residential development. So I personally think that residential is going to have a wonderful growth journey in the next 5 years. We're kind of at the beginning of the next cycle for residential, which means more velocity followed by pricing. But there's also a segment of developers like ourselves who think that there has been no better time to start a development, because now you are almost assured that when you complete your development, there will be lesser competition and the uncertainties of the next 2 or 3 years would have been behind us. So I think, the response on the restructuring is quite different for different developers. And those are the three kind of categories that I think of.
Great. Thank you, Amit. Vinamra, obviously, you have very, very diverse experience, and now you lead one of the largest global real estate developers that is very, very active in India. So as the leasing activity has slowed down considerably, what are the measures that you are taking as a landlord to try and bring back occupiers? And can you share your observations on different reactive measures adopted by occupiers, both globally and in India?
Thanks, Amit. I think I'd sort of rephrase the question a little bit, and the focus is really on what measures we are putting in to ensure the health and safety of occupiers. Because honestly, in these times, the way, and I'm sure all institutional developers look at the situation, is to show complete empathy and respect to occupiers who may not be comfortable to get their employees back for all the right reasons. So I think collectively our focus is not really to ask how do I get tenants back to park. I think that's an outcome once the situation stabilizes. But the bigger question is, how do I make sure that I make them feel safe and comfortable from a well-being perspective? So the focus and energies are really on that front. And I think that then goes back to a lot of points that Sanjay also mentioned earlier, where it's about giving confidence to the customers that once the employees are ready to come back, our parks would be absolutely safe from the point of view of exposure to the virus. And in order to do that, of course, a lot of investments have gone in, some short-term and some permanent, on the aspects of deep cleaning, ensuring a contactless journey, technology being put to use to a large extent. I think pre-pandemic, a lot of focus of PropTech was towards energy efficiency, operational efficiency, cost reductions. I think one key driver that has got added onto the applications of PropTech now post-pandemic is health and safety. So whether it is about putting UVGI solutions in your AHUs, or putting antimicrobial coatings and so on and so forth. And a lot of these, I think, are permanent solutions. They're here to stay because you're going to recalibrate the benchmark of what a healthy and well building needs to be in India, at least the way the institutional developers like us look at these, right? On top of that, we are absolutely ramping up testing camps, vaccination drives. We recently set up a COVID care center in our park in Bangalore, ensuring all the tenants are provided medical facilities like arranging oxygen concentrators to them, so on and so forth. So I think the whole idea is really right now to stand by the customers as a true partner and help them address the crisis at hand. And I think once we do that, that is where you solidify and justify the trust that at least the biggest Fortune 500 multinationals put in developers like us, that in times of crisis, we'll put in everything to ensure that from a business continuity point of view, there's absolutely no impact to the customers. And we are as concerned about their employees as we are about our employees, right? So I think all of these is how we're looking to address the situation. And the occupiers are thinking on similar lines. The conversations for us have mostly been around right now ensuring health and safety and business continuity for all our occupiers. Now, and then there are midterm considerations of, okay, so what is going to be the work from home impact on my overall real estate strategy? And honestly, enough has been said about that in the last 1 year. And I'm not sure if anybody's much wiser than we were a year back, because everybody's still figuring out what suits their own model. But I think there is enough time to have those conversations. Right now, it's really all hands at deck. And once we deliver on that promise, and once occupiers have that confidence, then I think you are setting up a platform which gives them trust whenever the market picks up. All those conversations about the business model and real estate strategy will all fall into place as the market picks up. So I think it's really, the focus is very different at this point in time. Yeah.
Sure. Thank you, Vinamra. So Arpita, obviously you've been long associated with real estate and investments into real estate, India and globally. So currently you have a large exposure in real estate assets. What do you think has been the impact of the occupier shifting preferences and the impact on the developer community? And how do you view the current RE assets in light of the post-COVID world?
Thanks, Amit. So I think from just for the audience, as a not strictly a developer in the sense we're investors, and our investment thesis is more doing development rather than owning completed and leased assets. So from that lens, if I look at the impact of COVID, I think the first thing we're seeing is that timelines are getting extended. Decision making on taking new spaces is on pause. That is something we are seeing as an immediate impact of, in the first wave, we were not sure. We felt, yes, this is temporary, and, there will be a sort of V-shaped recovery, but it's more W. So I think first thing we've noticed is that timelines are getting extended. I think what that does for us, at least, is it gives us, time to focus on redesigning and repurposing for the new normal. So things that Vinamra and Sunil will be doing in their sort of existing portfolios, some of those design changes, some of those physical infrastructure changes, we can incorporate as our buildings go online. Fire and safety, sprinkler system, fire escape, these are now just a part and parcel of any standard design. But we also believe that the learnings from this pandemic will also get incorporated as standard designs in the supply that is going to come forward. I think just repurposing perhaps will be a little harder than redesigning because there is just that element of having to retool what you have rather than redesign what's on the drawing board. There are many models. People are saying 70-30, 60-40, take your picks. 60% of your staff comes in at the same time. They should have more space. They should have a few extra facilities like a care facility, which probably would not have been the case, say, a year and a half earlier. So we will incorporate some of these things that we see others, best in class, that we see happening in India and across our portfolio globally. I think from an outlook point of view, our outlook is that other than timelines getting extended, fundamentally, our outlook in the medium term remains as we had underwritten. We are value investors, so we had sort of not underwritten aggressive growth either in occupancy rates or in rentals. So as far as our outlook on India and our own projects are concerned, we remain sort of on track to what we had underwritten. So remain fairly positive. I think one of it is due to the fact that we've all been beneficiaries of being able to work seamlessly because of technology. And the emphasis on technology will only grow. And as a result, India's sort of preeminence in the world from technology development will continue to grow. And it's not just a cost thing. I think it's cost plus skill plus scale. That's a hard combination elsewhere. I have worked for one of the technology firms briefly, and I can tell you from firsthand experience that replicating the model of engineers of this skill and this scale is going to be very, very hard. And I think India is going to be front and center of the world as reliance on technology increases. And office commercial real estate is going to be a beneficiary of that as that plays out over the next 3 to 4 years.
Thanks, Arpito. Vinod, you currently lead one of the largest real estate developers in India. Raija has a large pan-India portfolio. How are you seeing the key market shaping up in terms of rents, occupancy, and supply? And then any other additional insights other than what has been shared in terms of health and safety for the occupiers?
Hi, thanks for getting me on this panel. The opportunity of speaking last allows you to cover very little, but fortunately or unfortunately, most points have been covered by everyone. So that's a good start. So let me just address your question on demand supply dynamics and the occupancy dynamics, etc. The way I see starting with 2020 and then going into 21 now, I thought that the supply, which was looking like it was going to run away into all kinds of directions purely because of the record year you saw in 2019, is completely paused. Three things have happened. The speculative nature of commercial real estate, which had become quite aggressive, has tapered down completely. Secondly, you don't have speculative capital chasing under construction projects. Thirdly, it's very interesting to note that across the board in all the primary commercial markets, 90% of the commercial real estate is built for technology companies. And in each of these cities, the basic development potential has gone up 2-folds and 3-folds in terms of the FSI allowed to be built or the propensity of density, which is why projects earlier, which would have been costing you 200 crores, for example, to build on a piece of land, suddenly you require 600 crores and 800 crores to build those because your densities have gone up. What that does is delays your project timeline, and CapEx becomes a scarce resource. You can't put 800 crores of equity on your own. Very difficult to bring that speculative supply in. Lastly, the large institutional investors would have bought out speculative supply if they thought whichever markets they wanted to be in. Now they want only forward purchase or substantially complete and substantially leased assets. So you will see supply push out by 2 or 3 years straight away. Having said that, when we came into the first quarter calendar year 21, you saw grassroots of demand begin to happen because people were already talking about occupancies beyond 25% in the office by June, July. Sadly, as a country, we got hit by the second wave for whatever reasons. I think the way forward, if we are quite aggressive in making sure the workforce in urban India is vaccinated as soon as possible, and we can achieve that significantly in this next 3 or 4 months, then we are on solid wicket to see occupancy physically rise to 25-30% numbers by December. And if that happens, you're already seeing employment in the technology space gone up by almost 200,000 people in the last quarter. You've seen the results of the domestic companies and how they are performing because of outsourcing coming to India. And colleagues on the panel have already covered the fact that India is right up and center with that opportunity. And once you hire these people, you've hired them in tier 2 and tier 3 cities and wherever they are, and you're getting the jobs done. The minute you get 35% to the workforce, you're not just going to cherry pick only 35% of your workforce to come and work. It will be churned where 100% will come to work in shifts. And the minute you break that 35% threshold means you're capable of getting to 60 or 70. Let's not fool ourselves. You're going to go into an office building provided you've conquered COVID or we understand COVID completely. If you reach the 35 number, there's no reason you will not reach the 70% number. The minute that happens and you've hired people for new jobs, you will scramble back for space because let's understand in India, real estate costs you 3% of your operating cost. So if you have business and you have hired people, real estate is is certainly needed, and you will run towards grade A assets where you know health and safety protocols have been tested. Your partnerships with those asset managers are great. Rent is not going to be a criteria that answers your question whether you're going to see pressure on rent. So if you're looking at sub-dollar rents, there is no pressure. You might get premiums on grade A asset because you won't have supply on one side. You won't go into speculative supply of strata title. You will want large gated communities where you can be looked after and handheld 24/7. So you will see an impact on rents actually rising up with grade A assets when the demand comes back. You shift back 10 years at the middle of the economic crisis in 2009 and 10. The SEZ policy came exactly because of that. And we saw contracts getting cancelled left, right, center in 2009 and 10. We had built buildings which got vacated, right? But we held on to our nerve, built on to speculative, supply wiped out. 2 years later, there was not a single square foot available. We saw the biggest boom possible. And you hired 18 lakh people in the SEZ space alone in the last 10 years. There were 5% GCC GICs at that point in time. Today, you have 40% GCC GICs and growing. And if you want to save cost, India is the space for you. And with digitization and technology taking place across the globe at a fast-paced manner, you have no option but to come to India to hire people. And if you hire people, you're not just paying for resource, you're paying for data security, you're paying for the firewall infrastructure, the physical desk and chair, and the potential employee talent, which you need to nurture and grow because you're no longer doing back office, you're doing front office, cutting edge technology stuff. The guy can't sit in his house and feel motivated to work beyond the point. India is very different. You're going to have 4 people in the same chamari, no power supply, no electricity coming in most cities. You have to make your own coffee, do your own housekeeping, eat your own food, and yet be delivering 12 hours, 14 hours of work. And you can't be monitored, and you're taking risk with data security. And that's not sustainable at all. We all know that. All of us, given a chance, would be back on the desk. And having said that, with low occupancies in the technology footprint, you've seen a second wave of COVID. So clearly sitting at home is not safe for you. An office is equally safe, if not more. So all of these things will be put together. Obviously, we need to focus on vaccinations and making sure we get some sanity around that. And you will see a different take on real estate 6-9 months from
now. Great thoughts, Vinod, there. I think on the first section, great insights from all the panelists. Clearly, there are going to be changes, but it seems overall the developer-occupier relationship will continue to go from strength to strength. Clearly, asset quality upgrades to those assets. And then clearly, we all hope that what Vinod is saying is true and we are back to the offices as soon as possible. So looking at the investments on CRE, right? Clearly, real estate has been a favorite of the Indian diaspora for investing, as well as now the local, obviously HNIs find this quite favorable. So with the impending growth prospects, commercial real estate obviously is likely to show some signs of recovery. Clearly, 2021 in the later half is slated to come back in a more positive fashion, which means there's plenty of opportunities for investors. And despite the short-term disruptions, CRE will continue to find flavor. So Arpito, let me start with you. According to you, will CRE market see a steady flow of investment as it shows sign of strong recovery in the second half of 2021?
So I think the first good news is that just globally, a lot of dry powder is available. And dry powder is no good unless it's deployed. Secondly, for investors like us, we were very nervous with the froth that was there in the markets, pre-COVID. People were talking about Reits going at 6.5%, 7% cap rates. So, we were just nervous about how does one actually go and make money while taking India risk, currency risk, So I think this clearly, gives us a little more faith that we'll be able to get more fair value, real value in the current environment than we would have maybe in a pre-COVID scenario. I think, yes, the other thing that is happening is that the traditional sources of capital, banks and NBFCs, they will be constrained, at least for the next 24, 36 months. They will be absolutely constrained. But our developers are amazing, resilient people. They will find other ways to go about their business and capital, and it's already happening. Some interesting trades in Bombay through a structure of a bunch of HNIs pooling together, doing some barters. So people will solve. And then, of course, there is, the alternates like us, institutional capital, whose job is to deploy capital and to unlock value. So they are sitting with, dry powder, looking for the right opportunity. I think what is going to be thematic from an investor's perspective in the next 12, 24 months is that there will be a demand for solution capital. Unlocking value will not be plain Jane, check de diya, PDC le liya, or aapka paisa वापस आ जाएगा. That's not going to happen. You need to have capital that is well thought through before it is deployed. It is flexible to take into account for contingencies like we have faced in the past 12 months. And also, I think a strict element of discipline, both in the deployment of the capital and subsequent monitoring and harvesting of it. So I think if this change comes about, and it is already, I think capital will certainly follow the sector, and I think you'll see deployment. I think from a medium-term outlook, I think two things developers need to do is, to Vinod's point, speculative investment needs to sort of be a little more circumspect. You need to listen to your clients, and your supply needs to be synchronous to real tangible demand from them, rather than just plotting it on a growth path that you've seen historically. And also, again, redesign your product for what is going to be the new normal going forward. So I think if developers do these things, there is enough and more capital that will be available for them to ride through the storm. That is at least my personal view.
Sure. So Sanjay, in the current times, what are the parameters, both opportunities and risks, that investors should consider while making investments in the CRE space?
Sorry. Yeah, I think the future of investment, at least in the short term, belongs to IT parks, data centers, and commercial real estate, taking SEZ out. I think unlike last decade when we saw yield compression, that's not going to happen. So it's going to be very limited play as far as that is concerned. In comparison to last 2 decades when most of the assets were undervalued because the rents were low, going forward, there'll be far more stabilized rent. I think the portfolio, the average rent used to be, I think, in 40s, although tenants still want to pay 40 rupees only per square feet. But fortunately, from developers' perspective, that's no longer the case. And it's financially not viable. And I think now we're hovering around 70 to 80, but still $1 per square feet from the occupiers' point of view. So the exchange rate from occupiers has actually worked to their advantage. So I believe the investments will be more not your ability to develop the asset if you're seeking a partner as an institutional investor. It'll be the developer who has the ability to demonstrate asset management qualities, because markets are mature. Let me just answer from a very different lens. Suppose if you were to go to a lender today as a developer, the public sector banks or the NBFC would look at the profile, and on the basis of the credit rating, they will charge you the interest rate because of the risk factors. They may or may not give you the lending, for example. I think same applies to occupiers. They're already giving up properties, like I said, who are not relevant from their perspective today. And they're moving to properties which serves the purpose in terms of safety and well-being and also other such criteria. The other very important criteria in last 5 years and increasingly going forward, next 5 years will become is how's the infrastructure now around your facilities. So majority of the cities are witnessing metro connectivity, the last mile connectivity. I think most of the corporates are done, sending their vehicles to every resident employee and bringing them to work. I think the public infrastructure will become an extremely important criteria of an investment. So these are some big blocks which become the criteria. Asset management capabilities. So not just being able to build a property, whether you are able to build a brand and a scale that you have a clear differentiator amongst institutional owners, because there was a time when they were just considered tier 1 grade A developers. They were select few. Now we're talking about a competition between 400 million square feet institutional owners, which is very likely to see 50 million on an average next 3 to 4 years being added further. And Vinod made a very relevant point earlier that the speculative is no longer there. So opportunities are limited, and therefore development way perhaps would be one way to partner and invest. So I think these broad criteria would play a very important role. Is the certainty of investment a return, which will play a larger role than just the Excel sheet based probability factor and the risk factor. I think majority of the investors today have gone through a very sharp learning curve, and the challenges like how the developer has conducted during global financial crisis, during pandemic, has given these investors a deep insight into the ability and capability of a partner who can actually serve and sustain over a longer period of time. So I would give a higher weightage on these.
Sure. Thanks, Sanjay. So moving on to you, Amit. So what are the future trends in CRE that investors can expect to see in 2021?
I look at two aspects on this, Amit. One is the investment opportunity trends, and the other is project and asset level trends. So in terms of the investment opportunity, let me start with what I used to hear 2 years ago and what we've seen in practice in the last 1 year. 2 years ago, the common knowledge was every good quality asset there is to buy has already been bought, and yet in the last 1 year, you've seen 3 trades. Just those 3 trades adding up to more than $4 billion of investment in ready buildings, right? So what I'm saying is that the opportunities will be immense, and it always happens after a crisis because people react to crises in very different ways. So I expect investors will have a field day. They will have opportunities to invest in developments, in acquisitions, in forward fundings, and even distress, because there will be reactions of all natures. On the asset and project side, I think Indians are very quick learners, and one has seen the industry evolve. All of us on the panel, including those who are not on the panel, but I see several audience, have seen multiple cycles in Indian real estate, and the learning curve has been sharp for this industry, but we've always come up trumps. So the trends I expect are the following words. You hear them for the last several years, but they will pick up pace now. Health, safety, technology, flexibility, collaboration, amenitization, placemaking, and words like this. You just do a Google search on trends that have occurred in the Western world in the last 5 to 10 years. You will see them gathering pace and momentum in India within this year and next.
Great. Thanks, Amit. Vinod, so REITs are at an early stage of evolution in India. What's your outlook for REITs in India?
I think it's a fantastic opportunity for India. We are at the stage of infancy right now. If you look at the developed markets of the world, they are way, way, way ahead of us. And there's so much more to learn, to bring in from a governance, compliance, strategy, development, asset management, all of these aspects of the business. And I think if we can get that right, it will be a massive opportunity for India going forward. We are looking at 300-400 million square feet, which is already institutionalized. Very limited percentage of that is right now in the and if you look at the US markets, even a prison, hospitals, and name it what you want, it has a REIT listed. So we are far away from all of that. And I think there's massive opportunity if we can make sure we focus on asset management, don't think like developers, but as long-term landlords and relationship providers and asset managers. And you will see this a very different platform. I think the interesting part within the last 2 years or 3 years is that, especially in the last 6 months, you've seen a huge shift in the way high net worth individuals look at REITs. And that is still in its early days because right now it's just driven by the yield distribution. But obviously everyone likes real estate in India, just like a lot of parts of the world. Everyone wants to participate in the long-term growth. With so much disruption and noise and uncertainty around COVID, people are confused. But I think the minute that cloud passes by, you will see REITs being one of the favorite instruments for investment. And of course, if we are able to get SEBI to bring down the threshold from 200 units to say 5 units or whatever else you might call it, then you will see huge amount of investment coming to REITs. And a couple of other things that will bring it at par with equity, and then you see what happens. So I think REITs are very, very strong potential for India.
That's great, Vinod. Thank you. Vinamra, so now obviously there is an opportunity for the investors to look at the traditional commercial real estate assets, or there's the opportunity for alternate assets, right? Co-working, co-living, warehousing, etc. So what are your perspectives on investment in the traditional CRE or look at alternate type of investments?
Well, I would no longer put warehousing in the alternate segment. Amit, I think it is as core to the Indian CRE story as the commercial is, and probably even more in the future. But shared economy as a concept has been around for more than 4 or 5 years now. And a lot of investments, even in the non-real estate space, from Ubers of the world to Swiggies of the world, have all been driven on shared economy, the principle of shared economy, right? Real estate is no different. But I think what the sector has learned for real estate over the last 2-3 years is that co-working or flex office, or whichever you want to call it, is also not everybody's cup of tea. It's also not you get some free private equity money and you invest and you can make hay while the sun shines. And I think the way the industry has started to mature is testimony to that. There is no doubt that flex will become even more and more central in the strategies of occupiers post-pandemic. The question is not whether it will be, the question is really how much and in what form and shape, where today, whether an occupier is going to go with a 70-30 core versus flex strategy or a 80-20, so on and so forth. And if so, in what sort of business models? Is it a pure co-working or a more managed office kind of space, etc.? Those are the kind of questions that I think the industry is going to figure out. But the fact that this will remain absolutely critical, both to developers and occupiers, is a given. And there's no doubt about that. COVID has only accelerated that. But the other interesting thing that I think will happen with the whole flex office sector will be the fact that the financial feasibility of the model will have to stack up. I don't think that the industry can run on free money, investors with deep pockets without any questions being asked on the path to profitability. And that patience of capital providers will be very, very limited. And the questions asked to operators or developers who go into operating flex spaces, either ways, will be very tough. And I think that's good for the industry because it will make sure that there is a natural segregation between the more sustainable flex operators versus the ones who you don't know whether they're going to fold up tomorrow or not. So that's I think an encouraging trend. And this is one of the things that, along with, let's say, the Reits of the industry, which we're not talked about, is an indication of how the industry is maturing. And I absolutely foresee the same with the way co-working and flex space is going to go. And the same principle will apply to co-living or any other sort of co that you want to talk about. I think it will come down to whether the business model makes sense or not sooner than later. And I think that's a good thing for the industry. Yeah.
Vinamra, being part of this co-working industry for the last 6 years, I can tell you there is no free lunches with the investors right now. So, as we heard, investment climate is ripe. RE continues to be strong. And I'm no wealth advisor, but it seems like it's a great time to get into real estate investments, or at least give it a serious look. We're just about 10 minutes left, and we want to get some audience Q&A. So I'll jump right into the final section. So what's the medium to long-term outlook on CRE? And we have heard some of that already from our panelists here. So Amit, from your end, how well equipped are the CRE leaders to weather the current economic situation? You did mention that there are going to be some distressed assets, etc. So what do you think is the current situation, and how are CRE leaders equipped for it?
I'll keep it very brief in the interest of time. I think we are very, very well equipped. The CRE leaders of today, look at this panel, versus those who were around in the country in 2008. I think there is a wealth of experience now that there wasn't at that time. And I think that will be the single biggest driver of positive reaction to this. The big difference between last year and this year, and I speak from a COVID perspective, is that last year COVID was an unknown devil. There was uncertainty. We did not know the nature of the crisis, the depth of the crisis, the impact on business, and so on. Now it is a known devil. I admit that this year has been particularly hard on the health of individuals, and my heart goes out to every family that has had a health impact from COVID. But if you look at the stock market, it's the greatest indicator. The stock market fell 30% last year in the first wave and fell only 5% in the second wave, because the devil now. And I think that's what will help us overcome, and the future is quite bright.
Excellent. Thank you. Thank you, Amit. Vinod, so what are some of the strategic initiatives CRE leaders need to invest in to deliver value efficiently? We'll come back to Vinod. So Vinamra,
sorry, I missed you for a second. Yeah,
go ahead. So sorry, should I repeat the question?
Yeah, please.
Yeah. So Vinod, what are some of the strategic initiatives CRE leaders need to invest in to deliver value efficiently?
It's essentially a combination. Right now, we are still part of the learning curve, and where we evolve from here will be determined 12, 18 months. The way I see it is, I don't see tectonic shifts in the way you will deliver real estate. Certainly, health and safety, which was second priority to sustainability, will now become top priority. And you will see designs around that change and evolve. New ideas will come. We're still on the drawing board with those ideas. And ideas will still evolve as we get smarter about these things for the long term. So it's not just the pandemic you've got to work for, but you're cumulatively trying to explore how you can change the way you work, because a lot of the elements which were pretty standard earlier might need changes. So those will evolve over a period of time. You can't retrofit an asset to change it 180 degrees. You'll probably make marginal differences as you go along and correct it. But what's important is to understand even the way our customers are thinking. And right now, trust me, the customers still are evolving, and each one has a different strategy in mind. They don't have a hardcore solution on asset quality. They have solutions around occupancy, health and safety, all the other logistics around it, and all the aspects that we've already implemented. We haven't yet heard any major shifts in the way they want to occupy. And of course, the visibility will come from China and now from the US, where they're slowly getting back to work after vaccinations. So 6 months down the road, we'll have a far better visibility on how they see that.
Great. Thanks, Vinod. So Vinamra, going ahead, what are some of the key areas developers can focus on to improve operational efficiency?
I think you've touched upon that quite a bit, so I won't repeat those points, Amit, but I would just summarize that the importance of tech across the value chain, not just operations, right from construction to even investments, diligence, and the whole hog. So more and more tech being seen across the value chain. Tremendous focus continue to be on energy efficiency, cost reduction, and customer experience improvement. And underpinning all of that will be the focus on ESG, not just as something nice to project to the customers, but truly showcasing how it's integrated into the way you run your portfolio. Those who do these things well, I think, will stand out in the market.
Great. Thanks, Vinamra. Arpito, so according to you, what are some of the key areas that CRE industry needs to focus on as they recover and prepare to thrive in the next few months in 2021?
I think first focus on stabilizing. Don't chase growth. Just focus on getting what you're doing, do it well. Be disciplined in the capital that you raise. I think lastly, just execute and deliver. Just make sure that you are predictable in your product to your clients and in the way your investment is performing to your investors. I think there will be a flight to quality, both from a client perspective and an investor perspective. So bring in some discipline. This is a great opportunity for you to institutionalize, bring in good finance teams, project management teams, ESG teams. Those are not nice to haves. They are must-haves now. Make those investments, and the guys who do that well, are in for a good, long, strong run once recovery happens.
Great. Final question to you, Sanjay. How can CRE developers recognize the challenges and vulnerabilities at the asset and portfolio level efficiently?
I think all the due diligence that the institutional investors have done in last leg of investments have really educated all the developers. And I think the challenges that we've all gone through from occupiers' point of view, productivity, flexibility, operational efficiencies, right from global financial crisis days, that learning curve that developers went through, and then the learning curve with the institutional investors, because you had to kind of deliver on the promise that you made to the investors, incoming investors. A lot of learning has actually happened. I think a lot more due diligence, discipline, and a very realistic scenario building, which is what we've kind of moved to now, has become a key for most of the developers. And I think more than just the quality, I would say, is the high performance. I made that comment earlier. It's the performance of a partner, which will be supreme in terms of investment decision making that most institutional investors will do. And I think demonstrating that capability, demonstrating your ability to adapt in a very difficult time, because your speed to change or market will dictate whether you will succeed eventually or not, without taking a knee-jerk reaction also. So it requires a lot of discipline. Earlier, most of the developers had a very lean, short team, but with portfolios growing to 20 and 40 million square feet, each of us have, as principal employers, 2,000 workforce to 3,000 workforce. So, you have IT companies who have that kind of manpower to manage, but even developers today have those kind of responsibilities. At any given park of 4 million square feet, you will have roughly 200 people deployed from various vendors. So I think it's all of building those institutional organization capabilities that will really go a long way in serving the end objective of the business.
Thanks, Sanjay. Over to you, Sumit, for some Q&A from the audience.
Thank you, gentlemen. It had been a very, very insightful kind of a discussion. We have got very high quality questions, and thank you to you. A lot of these have been answered as well. My first question to all of you, just answer to me in a single word. What can be expected in terms of CRE demand in Q4 of this calendar year? So October, November, December, will it be high, moderate, low? I'll start one by one. Sanjay, what do you think? Just a speculative answer.
Moderate.
Amit?
Moderate as well.
Vinod?
I wish I had a crystal ball to tell you this, but yeah, I think it'll be more between moderate, and you'll start seeing demand come back.
Great. Arpito?
Muted with green shoots.
All right. Vinamra?
Yeah, I'll go with moderate. Yeah.
Moderate. And Amit Ramani, from you?
I think it's going to be great. It's going to be high.
Okay, perfect. Great. So there's a very interesting question around on hub and spoke model. We all have been talking about it. Now, how will it impact the absorption in the coming days? The hub and spoke model and the de-densification of office spaces. How will it impact the absorption in coming days? And how will it impact the economies of scale among flex office operators? So Sanjay, do you want to address this one?
Sure. Not substantially.
Okay, perfect. And it says many IT professionals have migrated to their natives, but are still open to work from an office-like environment. Do you think an opportunity that tier 2 and tier 3 markets will see a good traction from CRE front? Amit, from your side, Amit Devan?
Yeah, to be honest, I'm not well qualified to answer this. We don't operate in tier 2 and 3 cities.
Sanjay, Vinod, Arpito, or Vinamra, any one of you can take this.
I can take this very quickly. I believe not only tier 1 cities will remain in good shape, but out of 50 micro markets in India, only the 22, 24 micro markets will dictate. And it's largely because of the quality of social and infrastructure, which is gaining higher weightage in investment criteria.
Yeah, I think you got to keep in mind when everybody's back to office, which city you want to be based in. And the moment you start thinking about that, then you'll get your answer.
Right. We got some, couple of great questions from Ramesh Nair as well. Thank you, Ramesh, for asking these questions. Vinod, there is one question specifically for you. I'm not sure if you would be comfortable doing it, but what Ramesh is looking for is how much new space do you expect to lease, excluding renewals, in the next 12 months?
Unfortunately, we are in public markets, so we cannot give you any of those number pointers forward. But you may have got enough and more feedback from the current communication on where you see it. And Ramesh is a stalwart. He must have the pulse at the back of his hand.
Right. Ramesh should be answering that question than asking them.
Right. So, Vinamra, there is a specific question for you. What is your take on logistics and warehousing? As we see, a lot of funds and investors are very active in logistics and warehousing space. In future, for at least 2 to 3 years, will there be less investments towards office space compared to logistics and warehousing?
Extremely high demand for obvious reasons of what's happening on e-commerce and even manufacturing. The decider will really be too much capital chasing opportunities that are very tough. So ability to deploy capital at returns that make sense is going to be really the differentiator. So extremely important to find those right opportunities, but huge demand in the sector. Yeah.
Great. There's a very interesting question. What role do you see fractional investment playing in revival of CRE and also of taking A-grade CRE to a wider audience? So we are seeing a new model on fractionalization of real estate. Any thoughts from anyone around on it? Will it move the needle as of now?
I can take a shot. It's basically a play for tier 2 developers who realize better values, exit values through that route. As far as institutional is concerned, you actually create value over and above by making your developments as high performance developments.
Right. And to add to that, Sumit, I think the fractional model thrives on strata ownership, which is the exact antithesis of institutional ownership that we guys are talking about. That's the right. There will be a space, but it will not be a big competition.
Great. Completely agree with you. That's it from my side, gentlemen. Over to you, Amit.
Thank you, Sumit. So it's been a fantastic 60 minutes with each of you. I personally have learned a lot, and I hope the participants have as well. Thank you for all the participants to make this a success. We have had the highest participation of all webinars till date that we have done at Awfis, and for the panel to share their views candidly. We all hope that the CRE sees a massive resurgence in 2021, and CRE leaders obviously have their work cut out. As successful as 2020 has been for commercial real estate, 2021 could even be more so. So with that, the critical decisions that we make today, I think will have an impact in the next few years. With that, here's hoping for the best in 2021, and stay safe and stay healthy. Thank you.
Thank you very much.
Thank you.
Thank you.
Thank you.
Thanks.